What's up guys, welcome back to InvestingPH. Today I will introduce another segment in my channel. What better way to learn finance and investing than to learn from the greatest investors out there? This is through their books. Now I know most of you guys don't have time or encouragement to read books. So I will bring the book to you guys. I will share to you 5 lessons I got from the book of Peter Lynch, Learn to Earn, which was suggested to me by one of my subscribers. So let's start. Now before we start, you know the drill guys. Press first that like button, and if you haven't yet, do subscribe to my channel. I have a really great guest today in my video. Well, not physically, but through his book. So support my channel. Just a quick preview of who Peter Lynch is. He managed the Magellan Fund in 1977 to 1990. In which had an annual return of 29.2%. Peter Lynch is a firm believer of investing in stocks that you know and understand. Now these are the 5 lessons I've learned from his book, Learn to Earn. Lesson 1. Stop keeping your money stacked away in a piggy bank. Piggy banks are in no way of help in the economy. Worst part of it, keeping your money stacked away is it doesn't beat inflation. Imagine, not only is it not helping the economy, but as years goes by, you are also losing the buying power of your money. Now with investing, gets you both deals, saving and growing your money, and at the same time, helping out the economy. With the growth of the economy, more jobs can be made. Now it's really sad that in our country, only a handful of Filipinos invest. Less than 2% guys, that bad. No wonder our country is trailing from our neighbors. I have a video about that, you can check it out. And also a video about why saving won't make you rich. You can click the link above. So instead of putting your money stacked away, let it work for you and for the economy. Lesson 2. Discipline is key. Everybody wants to get that magic formula, but they forget that the greatest formula in being a successful investor is right in front of them. Just look in the mirror, yourself. Discipline is the key. Even with a great knowledge of investing, if you lack discipline, you will fail. A lot of people think they are long-term investors, but not until stock suddenly drops. Then you can see most investors who thinks they are in it for the long run becomes a short-term investor during market drops. This is a common problem. Sometimes a lot of people have bought great companies at a good price and sell it too early. They say they are long-term investors, but they are only willing to hold that for 2 months, sometimes less than 2 years. How can that be termed long-term? Nobody can predict when a bear market would arrive. Nobody told them to sell at a very low price. They volunteered to sell at that huge of a loss. Without realizing it, they fell into the trap of trying to time the market. If you told them they are market timers, they will deny it. But anybody who sells stocks when the market is up and down is a market timer for sure. A market timer is someone who tries to time the zigs and zags of stock prices, hoping to get out a quick profit. Few people can make money from this. No one has came up with a foolproof method. If anybody has figured out to time the market, his or her name would already appear on the top of the list ahead of Warren Buffett and Bill Gates. Trying to time the market, you would eventually see yourself getting out of stocks when they hit bottom or turning back up and into stocks when they have gone up and turning back down. A lot of people say this happened to them because they are unlucky, but in fact, it's because they are attempting the impossible. Nobody can outsmart the market. People say it's dangerous to invest during market corrections, but forget it's only dangerous when they sell. Also, they forget the other danger, not being invested in stocks during those few magical days when stocks suddenly rise up. Missing these few days would greatly affect your overall return. Imagine just these few days. So be disciplined enough. The magic formula is already right in front of you. You just have to be disciplined. Lesson 3. Make the decision. Invest your money yourself or let someone invest for you. Now, the advantage of letting someone investing your money for you, you just give them your money, you get to earn a piece of all the stocks in the fund with a smaller price to pay. You get to use the most simplest strategy, cost averaging. The longer you are in the fund, the more percentage you get to earn with the fund. But again, research first the fund that you want to invest in. You may be paying more for a fund that underperforms an index. Index funds mostly beat mutual funds. The disadvantage of this, you will have to pay fees. Usually here in our country, most mutual funds have 2% fees, while index funds charges 1% and ETFs about 0.75% fees. Now, fund managers have advantages like resources, high-tech computers, and they get the news earlier. These managers have investing as jobs compared to us retail investors that do this only as a hobby. If you are a long-term investor, ignore hybrid funds with bond and stocks. Invest in pure stocks. Stocks has outperformed bonds throughout history. And never jump funds. Choose one fund that has a long time record. People who try to jump from fund to fund usually fails and lose money. This is the same like in holding individual stocks. You jump from another stock because you weren't disciplined enough to hold it. Then the stock you chose again went down the same as your first holding. The cycle continues. That's why even when investing in mutual funds, study first how good the manager is and if that manager outperforms the index. Or just invest in a passive fund like an index which usually outperforms a lot of actively managed fund. Lesson 4. Individual stock picking have more work. People should know there's no investor out there that has a 100% win rate every time. Even the greatest investors like Warren Buffett had his shares of failed investments. Know the different kind of stock picking. So we will start from the lowest kind of stock picking. First, dart method. Just throw in the dart and pick wherever it landed. This is the lowest form of stock picking. Second, hot tips. When somebody else tells you to buy a stock, your best friend, uncle, brother, without any research about it whatsoever. Third, educated tips. Experts that appear in TVs and gurus. The problem with these tips, what happens if the expert changed his mind? You won't receive any update about it unless the guru would come back to that television show or create another YouTube video to say, oh, the stock has already gone up, time to sell. Fourth, brokers buy list. Stockbrokers buy list, usually done by analysts. This rely on the brokerage research. Usually brokers update what stocks to buy and sell. Now in my PhilStocks account, usually PhilStocks email the companies they have research and what their projection is. They issue buy and sell signals, etc. Fifth, doing your own research. Highest form of stock picking. Investing in stocks you like, your circle of competence. There can be ways you can have data about companies, like experiencing the stock firsthand or being an employee in the publicly listed stock. Another as a customer standpoint. Just going in malls can get you clues. This is the stock picker's eyes. There's also a catch in this one. It doesn't mean the company makes a popular product, you should buy the stock. You need to know the numbers. You have to know its financials. You have to know its past earnings. You have to have a clue of what the company's earnings can be in the future. You have to know if the company is selling at a bargain price. Everything. Here in my channel, I do stock analysis and review. And I always remind you guys to do your own research first when buying companies. Don't just listen to me or don't just buy the company because of my videos. Still research further the companies. My videos are only a glimpse of the company. It's still different when you do it on your own. Like what Peter Lynch say, my videos are only in the third stock picking method, educated tips. Because it's true, the purpose of my videos are for you guys to have a clue of what the company is, or maybe get some details that you miss out in your own analysis. Combine it with your own analysis. Lesson 5. Have your own strategy. Most investors won't be able to keep up with the hundreds of companies out there. You can specialize in certain companies. You either specialize in real estate or power companies, or maybe tech stocks. Maybe you can specialize in stocks that only gives out high dividends. Or if you are really great, you can be a hybrid of all, as long as you can evaluate the companies you own properly and be able to know if you are buying it at a good price. Now, if you have noticed, Peter Lynch really emphasizes on knowing and understanding the companies you hold, because this is really important, guys. With proper knowledge of what you are holding, this may prevent you in making mistakes, like selling or panicking when your stocks fall down after you bought it, or having sleepless nights because you are always thinking of whether or not the company you are holding will fail. But the thing is, don't just rely on those datas you get. You have to make sure those datas are correct and not full of bias. I tell you, a lot of videos out there just gives you guys what you want to hear. Oh, invest here in this hot stock. Of course, for the views, people often like it when they hear good things to cover up a bad investment. So really, do your own research first. Peter Lynch has emphasized this so much. Anyway, I think that's it for this video. I will do these kinds of videos whenever I finish a book. This way, you not only hear words that comes from me, but from proven legendary investors. So if you learned a lot from this video, do click the like button, and if you haven't yet, do subscribe to my channel. So see you in my next videos.